not everybody is buying into this bull market theory, by the way. In fact, PIMCO's Bill Gross is actually warning investors to be afraid, and I mean very afraid, of how inflation and the flood of cheap money will impact investments from here on out. Bill joins me now exclusively from PIMCO headquarters in California. Bill, good to see you. Thanks very much for joining us. So if not this stock market, what are you betting on?
Well, we are betting on the stock market. You know, we just think it's a baby bull, Maria, as opposed to a magnificent bull in Spain where they award 2 ears and a tail for the big fight. We think this is a return of 4 to 6% as opposed to double digits, which is what we've experienced in the past. So we like stocks. I think Bob Pisani has it right in terms of his agenda, if fulfilled. But the fact is that credit, at some point runs into a dead end in terms of its ability to engender real growth and profits. And so we're basically at that point in our view. We've expanded credit from $3 trillion to $56 trillion, since the early 1970s, and the ability of credit to generate more growth and wealth is reaching limits.
Right. Let me ask you this. I mean, let's talk about the downside risks of all this cheap money, because we all know why this market is rallying as much as it is. I mean, there are very few alternatives to multinationals that are paying dividends, that are getting exposed to some of the growth all around the world. Plus, you've got some indications of a better economy here. But the Fed is largely the reason. So what is the downside risk of the Federal Reserve stimulus?
Well, the downside risk is that there are negative aspects to zero-based money, to low interest rates. Ultimately, take the example of banks. Their net interest rate margins, their ability to earn a profit at a spread is reduced simply because yields have come down so low and they can't borrow at anything less than 25 basis points. Same thing with insurance companies in terms of their leverage and their ability to generate profits on money. Same thing in terms of pension funds. They're in a big hole these days simply because they've, underestimated their liabilities going forward. So all of these financial institutions, engender negative aspects to the real economy as they download, as they downsize, as they lay off people. So there are negative aspects to very cheap money, and I think Ben Bernanke has recognized that over the past few years.
It's interesting to see such momentum in the market, even though we have these disappointments in terms of real economic data. I mean, the GDP report, how would you characterize it, Bill? And, what's going to stop this momentum, given the fact that the backdrop is not that great? It's okay.
Well, the GDP report was certainly weak, and for the last 12 months, real growth has been 1.5%. It's been our new normal type of economy, Maria, simply because of some of the forces that we've described, the weakness engendered by zero-based money. Going forward, what's going to stop the momentum? I think rotations from bonds to stocks, which is the big agenda at the moment, basically work with a 3 to 6 month lag. It takes that long for quarterly statements and momentum to change attitudes and allocations among investors. And, since November 15th, stocks have begun to outperform bonds, and now by about 10%. And that should lead at some point to additional reallocations. But I will say that PIMCO, which, as you know, is primarily a bond firm, has had a great January. We've had $20 billion in inflows. And so we suspect that much of the rotation has come from cash and money market funds as opposed to bonds.
Well, I think that's a great point. That's what I want to ask you. Where is this money coming from? We don't necessarily believe fully that, in fact, there's this rotation going on out of bonds into stocks. You think the money's coming from cash?
We do. There were capital gains taken prematurely in order to beat the tax hike. There were extra special dividends given in November and December with much the same attitude in mind. And so the cash that has been resting with investor balance sheets is now coming into the stock market, basically bypassing bonds, but not using bonds as an allocation vehicle. Ultimately, I think the potential rotation from bonds to stocks, Maria, will be tempered by demographic influences. I mean, let's face it, boomers, 65-year-old boomers, 60-year-old boomers, like bonds, and they most likely always will. It's a preference due to age. They get old, they get conservative, they need to retain principal. And so, this great rotation will always be influenced by the boomers, which will not be stopped going forward.
That makes a lot of sense. So Bill, give me your ideas in terms of allocating capital today, and I recognize there are a lot of things to think about: your age, your, whether or not you're conservative or wanting to be aggressive. But generally speaking, in terms of bonds and stocks, what are the areas that you would buy stocks right here in terms of sectors, and what are and where specifically would you be boning up on bonds?
Right. We like stocks relative to bonds. We think stocks are in a 6 to 7% world and bonds in a 3 to 4% world. We like global stocks, that are diversified, that basically can take advantage of potentially a weaker dollar. We see that as one influence going forward, Maria. In terms of the bond market, we like TIPS, those inflation-protected securities. If we're going to get inflation from Fed check writing, and I think we're going to, not in 2013, but in 14, 15, and 16, then you want to be inflation-protected. You want to get some of the money out of the United States into Mexico, Brazil, Italy. They have much higher interest rates and decent balance sheets, by the way, in Mexico and Brazil. And I think you want short to intermediate maturities if you're located within the United States.
All right, we'll leave it there. Bill, always nice to have you on the program. Thanks so much.
Thank you, Maria.